All right, welcome to another expert interview. I have been hyping this one up because MC and I always have great conversations, and I've really been looking forward to this. I think that his approach to a topic that's super relevant for those of you who want to build legacy and lasting wealth and access that capital today, there's so much we can get into the weeds on, and I'm sure we will. Introduce yourself, brother. Tell us who you are and what you do.
Yeah, no, appreciate coming on. Thank you so much for having me, Devin. I always enjoy our conversations. Yeah, so my name is MC Laubscher. I have a firm called Producers Wealth, and it's a financial services firm that operates in all 50 states in the United States, but it's a little bit different. We have a completely different approach to finance and building wealth strategies. And it's different because it's tailored for the business owner and entrepreneur. Most of the advice that we receive as business owners and entrepreneurs is just tailored to the general public. So it's just blanket advice for the everyday person. It's not specific to any business owner or entrepreneur. And what you'll usually find is the things that the advice given to the general public, you should actually, as a business owner, entrepreneur, do the exact opposite of that. An example is losing control over your capital. You want access and control over your capital at all times to reinvest in your business, grow your business, hire employees, invest in IT, technology, AI, all these different things. I've been doing this for 10 years. And a big part of what we also do is infinite banking. That's the one kind of line of business that we do in helping business owners and investors to create their infinite banking system, their own banking system. Another part that we do is business planning and specific business planning around the business owner, their family, and then their business, what's happening inside of their business. Like, for example, how to protect the business owners and the partners as part of a succession and continuity plan for the business, how to structure retirement plans basically for the business owner, which doesn't take capital away from the business, how to diversify capital from the business owner without losing control of it, the business owner and the business without losing control over it. And then also how to maintain key employees. That's a big challenge that every single business owner has. We all want A players, and sometimes we're in a position to find them. How do we keep them? How do we keep them motivated? And how do we keep them in alignment and excited to be a part of the business? And then also family planning, like a lot of family succession planning, multi-generational wealth strategies, kind of family office style planning. So that's what we do. And I also have a podcast called Cashflow Ninja. And it's funny how this started. I started Producers Wealth in 2015. So we've been in business 10 years. And in 2016, I launched a podcast. And the reason why I did that is a lot of our clients, business owners and investors, they do incredible things. And I was having these amazing conversations. Like every conversation I was having with a client, I'm like, I should have just recorded this. This is gold. And then I started doing that in 2016 and started publishing it. And that podcast got a life of its own. Blessed to just have interviewed some of the best minds in business and investing. And before you know it, we were rated on all of it was iTunes back then. Now it's just Apple Podcast charts. And we've had close to 8 million downloads in over 180 countries. And we continue to publish a podcast weekly with that show. But that's what I'm up to these days. So Producers Wealth is the financial services firm for business owners. And I also have Cashflow Ninja, which is the weekly podcast.
Love that, man. Let's plug the book because I see there's two books over your shoulder. So talk to me about what books do you have? What's in them? How can people engage with those?
Yeah, under the Cashflow Ninja brand, the number one question I received after interviewing the best minds in business and investing for almost a decade, 9 years, is, hey, what are some of the most interesting strategies and investment opportunities, niches that has been shared on your show? So I put those in 4 books. So we have the 21 best cash flow niches, the 21 most unique cash flow niches, the 21 best cash growth niches, and the 21 next level cash flow niches. There's 21 in each book, spoiler alert, but we also give bonus niches So you probably have over 100 between the four books. And it's just me sharing these incredible ideas and ways to generate income and business opportunities too. So those are in the four books. And then, of course, I had a blast doing actually the one that is, I get excited about this book every single day, called Get Wealthy for Sure, the number one financial strategy for business owners to multiply wealth predictably, which I did and collaborated with you. That book really, we've reached so many people sharing this strategy that not a lot of people are aware of. And we continue to reach more and more people every single week. It's the emails that I get, the text messages, and more that from that book has been great.
Love that, man. There's so much wealth, and I know you share so much info, and so I just want people to know that there's a lot of ways to lean in and get more. What I want to ask you is, let's pull the curtain back because I think this is something that sets you apart from most advisors. You are totally 100% eating your own dog food, drinking your own Kool-Aid, whatever analogy you want to use. So I think
Yep.
it's important to ask that because as I got to know you, that's really the thing where I started leaning in and going, oh man, you're not just telling me to do this stuff. Like you are fully immersed in this and you're using the system. So give us that sneak peek. How are you using what you teach?
Yeah. And I'll just share kind of a background where this all came from, because to your point, Devin, that like the firm that I created is something that I wish that I had that wasn't there. So I'm originally from South Africa, as you can hear the accent, and I ended up in the United States. I came here in 2001, a couple of $100, backpack, suitcase, sense of humor, and sense of adventure. And I played sports here in a league up until 2007. So I played in a national rugby league. And then while I was doing that, I was just reading. I was the guy reading business books and investing books on the team bus or team plane. Yes, I was that guy. And I read Robert Kiyosaki's Rich Dad, Poor Dad, which just obviously the number one lesson right away from the book was cash flow, right? I read that book every single year, and every single year I pick up something else. But the first time is cash flow. Then I bought real estate property within the first 6 months after reading the book. And I put tenants in the property, collected rent, paid all the bills, and there's cash flow. I'm like, this is amazing, just like the book. It's great. So I started building my real estate business because I've always been a strategic thinker. So I'm like, listen, this is great. This run's going to end. I'm going to stop playing sports at some stage. I want something to retire to. When I'm done with this kind of chapter, I already want the next chapter set up. So I took some of the money that I was making playing sports and then also odd jobs, and then I put that into building the real estate business. About 3 years later, I read another book, the same book, Rich Dad, Poor Dad, Robert Kiyosaki, and the other one, Cashflow Quadrant, is his second book, was just as good. I reread Rich Dad, Poor Dad. And in the book, the third or the fourth time I read it, there's very simplified financial statements in there. So you've got your income statement, balance sheet. He simplifies it really well. And I looked at that and I'm like, man, all these liabilities that I have is someone else's asset. And even though with real estate, it's great, you can leverage the bank's money, buy the real estate, generate cash flow, get the appreciation, tax benefits, all the good stuff. But so, I feel like the real estate and all that stuff, that's pieces of the board game. What's the board? And the board was the person that everybody else who's out there's got a liability. They own the board, and it's the banks. I'm looking at that. I'm like, the banks, all the liabilities are assets of the banks. They're generating cash flow from that. And then the other epiphany was like, it doesn't matter whether you save money in a bank, whether you spend it, whether you borrow to spend or save or invest, the bank makes money. And then as I had that revelation, I came across the work of Nelson Nash called Becoming Your Own Banker that really shares with you. And he calls himself the discoverer of the infinite banking concept because he just made what was happening in family offices understandable to everybody else. He took that strategy straight out of family offices and took it to everybody. Then I met someone through the network that I was in playing sports. They're like, hey, MC, you like real estate? You should meet this other person. He likes real estate too, and he's in real estate. Turns out he was one of the biggest real estate investors on the north side of the city of Chicago. He's family, three, fourth generation legacy family. And we have had interesting conversations. I worked for him while I was not traveling, playing sports, and he taught me his entire family strategy. His great grandfather started the business, but we have our operating businesses that generate cash. Then we put it into our own banking system through this infinite banking kind of strategy. We leverage that capital and we just buy real estate and we do it over and over. Always had access to capital, always had access to liquidity to hire more people, grow it, to reinvest in it. And then I looked at their investment portfolio, always had access to capital to grow and scale their portfolio. And I looked at that and I'm like, this is wild, because the financial advice that business owners and entrepreneurs would get is, hey, you should diversify from your business, which is a great strategy, by the way. But the way then that is shared of how to do this is, give me your money, I'll put it in stocks, bonds, and mutual funds, and then diversify it that way for you. There's a couple of challenges there. What you've just done is you've lost control of the money, you've put it in someone else's business, maybe Apple, through Apple shares. Not that I have a problem with Apple. I love Apple. But you're now funding, you're funding Tim Cook and Apple, and you're providing liquidity to their business. So the big thing that I saw was like, this doesn't work. The advice and the strategy. And then I saw in the financial services world too, that it's actually like the incentives are not in alignment at all for the financial professionals that's helping the business owner, or let's just say investor. And it's not because they're evil or bad or terrible. It's just that's how it's structured, right? So I looked at this and said, okay, there's a problem, because the incentive, let's just say, for the financial advisors to get assets under management, so they need capital because that's how they're incentivized. Where for the business owner, he needs his capital because he wants to grow and expand his business. And the investor needs his capital or her capital because they want to grow and scale their investment portfolio. So I looked at that as, how can I build something that works for the business owner and then for the financial professional? How do you create a win-win in that situation? And then in my real estate business, setting up my own banking system using the strategy of infinite banking, funding my deals. And then eventually I created this kind of like little coaching group where I would share with other people what I'm doing in these meetups. And we used to do it in real life. Before meetup.com and so forth, you had all these real estate groups and stuff. So I was teaching what I was doing and sharing, and other people were then interested in it. And eventually I'm like, listen, there is a real opportunity here to actually build something and help more and more people, because I, at that stage, felt like, hey, I need to get this out. I need to share this with as many people as possible. I actually leveraged my infinite banking system for the money to start that business after using it in real estate. And ever since then, we used it to pay off my wife's student loans. We have used it to grow and scale our business, invest in other businesses, use it to grow and scale our investment portfolio. We've set up a family banking system with 12 policies that we have right now in our family bank, where the family bank now becomes the primary bank. Again, a thing that Nelson Nash said and shared is, every person should be in two businesses at all time: the business that you're in, and then the banking business. Producers Wealth this year, we hired some employees. We invested a lot of money back into the business. We did not go to a bank for that money. We went to our family bank, which is our banker now, and then got capital to reinvest in the business. Devin, you hit on that. In the financial world, especially, besides the not being the right alignment and incentives weren't aligned, the other thing that I also saw was that a ton of people are selling stuff that they don't even use, a lot of products and services. In my firm too, we all practice what we preach. We eat our own cooking. We live this ourselves. We practice it every single day, and been doing this for years, which is the other kind of differentiator, is we actually do this. So when people come to us and we advise them, I can share with them, not based on any theory, but hey, this is what you're going to struggle with, or these are some of the challenges that you're going to run in, and this is how to overcome them, because I've done it and my advisors have done it.
Let's get real basic for people who maybe don't fully understand what we're talking about. So what is the base of infinite banking? What kind of policy is that? And then I have a follow-up question you can answer at the same time is not all those policies are equal because I know that's a conversation we got into where there's a lot of people selling whole life in a lot of different types, but they're not all going to fund what you're talking about properly.
Correct. Yes. And so what infinite banking is, you're using properly structured life insurance policies as the vehicle for the strategy. I think it's very important to differentiate between a strategy and a vehicle. Why? You can do the exact same thing with a ton of other vehicles. So when you're looking at a place where you position capital and then you use that capital and place it as collateral for a loan, there's a lot of different ways that you can do it. One of my early mentors, and this will explain it in very basic terms, he had a strategy that he shared with me. This was in one of those real estate meetups in the early 2000s. He was an older gentleman and he said, "We did some crazy things in the 70s." I'm like, "Yeah, I bet. What did you do?" He said, he would take $100,000. He would go to a bank. This might be a mic drop. Put it in a CD in the bank and lock up that $100,000 for 12 months. Why? CDs paid 10+% then in the 70s. So he would have $100,000 in a CD, a certificate of deposit, locked up for 12 months, earning, let's just say 10%. He would go then back to that exact same bank and say, "Mr. or Mrs. Banker, I have a CD of $100,000 with your bank. Can I place that as collateral for a loan? Meaning, can I borrow against that $100,000 that's in that CD?" And the banker would say, "Of course, we're in the business of taking money and deposits, and then we're in the business of lending. This is our business model." So that because they had the collateral, the cash in hand that he would borrow against, meaning if he didn't pay them back, they would just take the CD. He would then take that $90,000, buy real estate, and then put a tenant in there, paying rent, collecting the rent, and paying back that $90,000 with the cash flow from the property. Now, what he had happening there was many things simultaneously. He had money, $100,000, that's earning 10% every single year in the CD. Then he had a loan, which he bought real estate from, which then generated income for him and gave him great tax benefits. It appreciated in value. That's the strategy with infinite banking. You're just using life insurance as the vehicle because life insurance also has many other qualities that the CD doesn't have. So with life insurance, a very properly structured, it's a dividend paying whole life insurance policy with a mutual life insurance carrier. Mutual life insurance carriers have been around for 170 years now. They've been profitable every single year for 170 years. And because it's a dividend paying whole life insurance policy, you're a shareholder of that mutual insurance carrier, which means every single year when they're profitable, they distribute profits amongst the shareholders, which are the policyholders, and they come in the shape and form of dividends. So that's why it's very important. It's got to be with the right carrier and then the right policy structured correctly. And for it to be structured correctly, the focus isn't necessarily on the death benefit. That also comes into factor later, but the focus is on the cash value. So usually if it's structured correctly, you want 70+% of your premiums going directly towards the cash, the savings of the policy. So if somebody puts in $100,000 into one of these policies, you should have 70, 75, 80% of that, let's just say $80,000 available within 30 days that you could place as collateral, like my mentor did with a CD for a loan from the insurance company. Right now, the dividends are about 6%, and the loan rate is around 5%. So you're earning 6% tax-free in that policy, and then you get to use that loan at 5%. Again, why is it so low compared to a home equity line of credit, which is at 8, 9%? Because of the type of collateral. They have your capital. That's why. But why do you use this vehicle? Because the money that you put in there is guaranteed. It's guaranteed to grow. It's never going to go down in value. It grows tax-free. And then the dividends, like I said, is around 6%. That's very conservative, by the way. In 2008, 2009, when the stock market crashed and the real estate market crashed, not only did people in these policies not lose a cent, they earned 6.34% tax free that year. And then you get to establish a line of credit, a loan at 5% that you can then use to invest in your business, grow your business, hire employees, and so forth, or grow your portfolio. There's one thing that I also wanted to really emphasize. When that mentor of mine borrowed against that $100,000 in that CD, he never touched the CD, by the way. The money just kept growing with 10%. He didn't draw it down by 90 and he only had 10,000 in there. No, he still had 100,000 earning 10%. And then he got a loan for 90,000 and 8% and bought real estate. You're doing the same thing with your life insurance policy, that you never actually touch the money inside of the policy. You just use that as collateral. So you get uninterrupted compounding tax-free in the policy. And then you get to borrow against it 5% to then reinvest in your business. So I'll give you a practical example. This year, when we borrowed from our family bank for Producers Wealth, what we did was, and you could get very creative with this, the family bank issued a note to my company. They charged Producers Wealth, let's say $100,000, they charged Producers Wealth 10%, which is a pretty fair rate right now if you look at business lines of credits, HELOCs, and more, I would say, quote unquote, riskier lending practices. 10%, pretty much a good market rate. And then my company used the money to hire employees, invest in AI, and so forth. And then we paid back the loan, paid the 10%. So let's just say paid $110,000 back. The family bank that we had, they kept the spread of the 5% made that they between the 5% that they borrowed from the insurance company versus the 10% that they loaned me. So they made a 5% spread right there. And the money in the policies were never touched, ever touched. So it just kept on growing uninterrupted. So that's what it is, Devin. There's a difference between vehicles and strategies. You could do the exact same thing with real estate. You could get a home equity line of credit secured by the equity in the home and do the exact same thing. It's just not guaranteed. And obviously there's higher rates of interest that you're going to pay. You could do the exact same thing by placing the assets of the business as collateral or receivables at a bank and get a loan from the bank. You could do the exact same thing with gold, silver, and art. There's actually a ton of us, and I've actually used gold in the exact same manner. So you could do infinite banking with it, but it doesn't have the other benefits that the life insurance has. You could do the exact same thing. Now, at the time of recording, crypto is red hot again. You could do the exact same thing with Bitcoin. That's not something that I would advise because it's a very volatile asset, but you could do the exact same thing. You could get 50% of the value of the Bitcoin as a loan, placing the Bitcoin as collateral. You could do the exact same thing with a stock portfolio, which Elon Musk actually did when he bought Twitter and it became X. He borrowed against his Tesla shares and then used that loan to put the down payment for Twitter. And then Investments Bank came in with the rest of the capital for him. So it's just a strategy of keeping control, because using the life insurance, by the way, which I know is like a 4-letter word, the life insurance has a ton of benefits that the other vehicles don't have. And that's why in family offices, these ultra affluent families, that's why they use the life insurance, because it's guaranteed to grow tax-free. The death benefit is also a big role when you look at multi-generational planning. And the death benefit, again, through proper structuring, can be tax-free forever. So every single year, every single generation will get a windfall of capital. The Rockefellers have popularized this method. It's called the Rockefeller Method, or they call it the waterfall. But essentially, they would max out the death benefit on the first generation. The first generation would pass. A windfall of millions, and in their case, billions, would go to the next generation. And then life insurance is maxed out on the second generation. When they pass away, it goes to the third generation, a waterfall. And millions of dollars then gets transferred efficiently tax-free to future generations. And that's why with each and every generation, that family becomes wealthier and wealthier. The wealth just grows contractually by contract. But that's what infinite banking is. It's a strategy of keeping control of the money. You're using life insurance instead of just a bank, because you're now the bank. Whether you save, whether you spend, whether you borrow to spend or invest, you're now the beneficiary from the system that you've built.
Let's go in the weeds on that waterfall, because I think that you hit it, but I want to push just a tad because I have read a lot of the infinite banking stuff, and I feel like the way you explained it was great. And I think to set the stage for people, I think the scenario is right. Like you pass, let's say you have a traditional insurance policy and maybe some other assets. Those assets get transferred to the next generation. Maybe it's taxable, maybe it's not, but it gets transferred in cash. And so now that generation, then you have to trust they're going to dispose of the capital or use it properly. That's not the waterfall method, right? The waterfall method is different, yet it still gives them access to capital so they can invest and grow and do things, but it protects the family's wealth. So let's go just a little bit deeper in the weeds there so people can understand when you pass, what does that look like?
Yeah, absolutely. And I'll just give a very brief overview of a family office structure. So when you have a family office structure, there's 5 components of it. And this is very important to understand where this kind of fits in. But the first piece of it is the family legacy assets. So every single family has a family constitution and a family statement of purpose. So the statement of purpose is like the Declaration of Independence. The why. Why are we creating all of this? The Constitution is like the US Constitution, how this will happen. And those are very important documents when it comes into the trust. Then there's other legacy assets, but that's just a good kind of a good overview of the first pillar. The second pillar is legal, tax, and insurance frameworks, which is very important in this strategy, especially the waterfall. The third piece is the family bank. The family bank is at the heart of this family office structure. The fourth piece is asset management, investing with time horizon of 100 years plus. I interviewed Jim Rogers, famous and legendary investor, and he actually said, MC, if you only can make 10 investments your entire life and you have to invest for the next 100 years, what would you invest in? That's why he's a commodities guy. One of the reasons, because that was one of the answers he came up with. The fifth piece is the family mastermind, which is the glue to keep this all together, to make sure that everybody's in alignment in the family. They all are in alignment with the statement of purpose, the family constitution. To your point, we'll make sure that and ensure that this continues to go on for generations and generations. So tactically, what you do is you max out the life insurance on each and every generation. You have the family bank component and you have life insurance that's maxed out on all the family members. How they access capital is they don't just get money when somebody dies and a parent dies and they get a death benefit. No, that money goes through the trust structures into the family bank. So no family member just gets a check. They have to apply to get money from the family bank and submit a business plan. And in the business plan, it could be for starting a business, buying real estate, obviously educational things. If you needed to go to a university or any other educational things that's going to help the family member, you can apply to the family bank. And there's other things that you can also apply for, primary residence and so forth. Then there's a repayment schedule that you also submit with it. So all these family members have access to the capital in the family bank, but there's a lot of strings attached, almost as many as Pinocchio had before he became a real boy. It teaches them a lot of different skills. Imagine if you just wanted an automobile as a child, a 15 and 16-year-old, and you have to submit a proposal for the funds that you want, explain why you need it, what car you're going to purchase, and then why you're going to have to repay it, and also negotiate with the family bank, perhaps, and so forth. But anyway, this is at the heart of it. So with every single family member that passes, the death benefit goes through trust planning into this family bank. And there's a liquidity event. And within the trust, It's structured that more life insurance is than bought on family members. This is why, too, Devin, that you've probably heard this, and it sounds borderline insane when you hear it the first time. But you've probably heard when you just ask a regular person how much life insurance they want to purchase, they would be like, as little as possible, maybe to cover the mortgage, maybe leave something for the spouse and the kids. If you ask a family office type of family, an ultra affluent family, how much life insurance you want to buy, they say as much as carriers would sell us. And that's why. Because number one, you have a family bank structure that provides liquidity for everything that the family needs. Number two, every single family member is insured for their maximum protection so that with every single family member passing, there's a liquidity event. And then that money is then deployed again through these contracts. So they've been doing this over. And that's why you're going to have a black sheep in a family. That's probably a shocker if you're a parent listening to this, but you'll have a black sheep, someone that, it does not show this, is not the steward of capital and show the discipline that, let's just say, the other family members do. So how do you deal with that? At some stage, if they borrow money and they don't pay it back, they're cut off. They cannot qualify for more loans. And the other thing is eventually they're going to pass away. So even if you had a family member like the Rockefellers that was very irresponsible, was not a good steward of capital, lived a lavish lifestyle, the family trust will be made whole when that family member passes away. So yeah, it's at the heart of this, right? The real assets are the humans. Now, that's what they understand better than anything else in these ultra affluent families and family offices. They know that it's all human capital. That's why the mastermind is so important. Teaching all these principles that the family lives by, the values, and of course, being in alignment with the statement of purpose, with the family constitution, because eventually the family members oversees the family bank. This is something that everybody needs to be in alignment with and on board with. But it's a very powerful strategy. I just want to share this too. You don't have to be a Rockefeller to do what the Rockefellers do. You don't. If you're listening to this and saying, I'm not a Rockefeller, so this doesn't apply to me, you literally can start where you're at and implement some of these principles and strategies, and it is going to make massive changes for you and just in the future of your life and your family's life. So I don't want folks to hear this and say, well, it doesn't really apply to me. I started where I was at 2 decades ago when I ran into that friend of mine or met him and I saw his family's strategies and setup. And I said, what if I just can copy and paste that and take away a lot of zeros, but just start where I'm at and then build it from there? Every single year, this system is going to grow my wealth incrementally. And now looking back 2 decades of it, I'm like, it's a lot of discipline, obviously, but you start where you're at and you just build from there.
Talk to me about how you can change your coverages. This was another thing, specifically when we worked on your book. We had this moment, and you said, look, by having this set up properly, it's changed the way I buy my auto and my health insurance because of the access to capital I have. And I'd never heard that actually. You just glossed over that. So explain that a little bit, because I thought that was an interesting take on what happens when you have access to capital.
Yes. So when you set up the system correctly and the policies are structured correctly, it changes your entire financial situation and your cash flow within your personal, your business, and your investing worlds. So if you look at personal, there's a lot of insurances that we have. And just saying the word personally, insurance, it gives me a bad taste in my mouth. I don't think there's a person that jumps up and down paying any insurance bill, especially if you think of property and casualty, right? So what you can do is you can raise the deductibles on all of your other insurance policies. Why? Because you have access to a pool of capital at any given point in time. One of the examples that I shared, a personal story, is we went shopping for health insurance as a family. And it was just insane for a family of four to pay, what was it, over $3,000 per month for just to have four healthy individuals insured. It just blew my mind. So we took the highest deductible plan, which eventually brought it to under $1,000. And this has been going on now, boy, 10 years that we've paid less than $1,000 a month and with the highest deductible plan. Now, has anybody had any health issue or episode? We're a very healthy family. I had to have emergency surgery to have an appendix removed a couple of years ago. That was one of the things that happened. But because we were able to save $2,000 a month for 10 years, which all that money gets diverted into our banking system, our liquidity pool, when that happened, it was fairly simple to just cut a check for the deductible that one time and meet our deductible, as opposed to this cash flow leak that you had in your very own system for years. If you think 20 was, we're looking at around $240,000, if I do my math correctly, that would have gone through our personal economy and just go out straight to a health insurance company, which all was captured in our own banking system. And eventually, when I needed to pay the deductible with between $15,000 and $20,000, whatever it was an easy check that we wrote from our system, and as opposed to the $240,000 that went through our personal economy that went into our system. You could do this with many other insurance policies. Disability insurance is pretty expensive for entrepreneurs, business owners. If you're in any medical field, that's something that you have to have, right? Especially if you're a surgeon or dentist or something like that. You could raise the time deductible on a disability insurance policy as high as 6 months. Why? Because you have a liquidity pool. That has saved thousands and thousands of dollars for us personally, too, that goes into our system. So if something does happen where there's an event of a disability, then we have a system which then we can draw income for 6 months of our living expenses before the disability kicks in. So it's just a more efficient way, and it's the philosophy of insurance, right? The insurance itself, especially when it's property and casualty, it's there in case of a worst case scenario. Using a car, it's there when a car gets severely damaged and or totaled. It's not there for a fender bender or a screen. By the way, twice I just paid out of pocket to replace a windscreen on both of our vehicles instead of filing another claim, which raises your insurance. And everybody knows dealing with an insurance company to file a claim is almost like going to a bank and applying for a loan. It's not a pleasant experience. Yeah, it's just the efficiency. So cash flow, when you think cash flow, everybody thinks a rate of return or return on an asset or something that pays you. But you could make tweaks to increase the efficiency of cash flow within your own personal, your business, and your investing economy.
Let me highlight something you say, because I'm letting you talk because there's just so much packed in there, and I want people to get as much packed in as possible. I want them to understand, one, you have to have discipline if you're going to do this strategy, because what you said is, it's not that you just saved the 2,000 a month, it's that you redirected that 2,000 in savings into the bank, which then creates all the things you already talked about, right? Principal growth, tax-free this, dividend payouts, blah, 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 blah. Then you can access it when you need it, which then covers the deductible. So I just want to make sure that they heard that part. But it really creates this creativity around what's possible. And that's what I really want people to take away is, like, there is a strategy here that, again, MC's using, he's teaching, and he can tell you with your situation where you might be able to find leverage, and then again, redirect some of that cash flow. So to your point, you're not losing that 2K a month that you're never seeing again. Instead, you're redirecting.
You have to have a plan, a cash flow management plan for every dollar that comes into your personal business and investing economy. Because if you don't have a plan, the universe and the world around you has. If you don't have a plan for a dollar that you saved, like in that example that you shared, and it's redirected into a different area, it's going to be spent. It's going to leak somewhere else. It's no use that $2,000 extra a month just sitting in your bank account, and all of a sudden you're finding all these wonderful things online on an Amazon, or that you've had an Amazon cart full of it, and all of a sudden that $2,000 is gone. By having a plan and being intentional with it, you are now redirecting it into your system, which then by A contract grows tax-free and has all these other benefits and then fuels your family bank. One of the biggest things that we talk about too is because people would say, well, I save 10 to 20% of my income, I can use that. But we don't think about all these cash flow leaks that we all have them. Think here's low-hanging fruit. How many membership subscriptions, if you're listening to this right now, do you have that you don't even use? And you just get billed or charged every single month for it, whether it's on a credit card or just gets automatically deducted out of our account. You would be shocked just to do an inventory because we live in a world where everything is basically subscription based. And I would argue and say 80% of the time, we don't even use any of those subscription things. Just by doing that, you're already freeing up capital. Again, let's have a plan for it. Where does it go? A sweep account is a great start. If you're listening to this and thinking, where do I even start? Open up a separate sweep account that is not connected at all to your online banking. You actually have to have a separate login and sweep it automatically into that account. Why? Because if it's just connected to your regular bank accounts, you're going to see it sitting there. You want something that's out of you don't see it. It's not visible. So you're just sweeping it automatically. There's many different things that you can do. It's obviously discipline, but there's also so many tools right now that you can use that's available. There's some great just apps and tools of automatically sweeping capital into a sweep account, and eventually you just sweep it into a policy until you set up a policy, right? I would say that's like step one. And do an inventory. Look at all the insurances that you have. Look at all the subscriptions that you have. Look at inefficient loans, and that we could do an entire hour just on inefficient loans and inefficient investments and that kind of stuff, where you can reposition capital to actually be in alignment with you and what you're trying to accomplish, whether it's you as a business owner, whether it's you as a family, or whether it's you as an investor.
Love it. You mentioned retaining employees, and I know that is such a hot topic right now because the talent crisis is happening. So finding people is hard. You want to keep the good ones. How do we use this infinite banking strategy to retain employees? Give us a quick answer on that.
Yeah, I'll share a very quick story to give you an answer. So I have a client that his wife was recruited as a CEO of a large healthcare company. And it's funny that in recruiting her, what they offered her was shares and then incentive performance bonuses of getting more shares. And the other one was life insurance. Why? This is where the retaining comes in. They said to her, if you stay with us, your term is, let's just say 10 years. Every single year, when you hit these goals, we're setting aside, let's just say $1 million in that life insurance policy for you. If you leave or quit before that 10 years, or it's not done mutually through the board or so forth, if you just leave and go somewhere else, you don't get any of that. We retain then that life insurance policy. But if you stay with us for 10 years, let's just say in that contract, and we put $1 million a year for you, you can leave with, and her policy would around be $12 million tax free after 10 years. Now, that's just an example of how creative you can get. You can have someone say, look, if you stay with me 10, 15, 20 years, and every year this is what we're putting away for you, in 15 years, this is what you would have as just one of your incentives. But if you leave beforehand, obviously in contract, that stays with the company then. So there's a big incentive for the employee to stay for the full term, the A player, and then perform, right? There's a performance incentive to hit the numbers every year to get that money in that policy. And then there's an incentive for them to stay for whatever time period you come up with and you want them to stay. But yeah, you could get very creative in how you structure incentives and how you keep them. And if they're in alignment and they're excited and they keep hitting those goals and the money keeps staying there, they might even, when that 10 years done, be like, I don't want to go anywhere. Could we do another one of these?
That's awesome. How can people get a hold of you other than listening to your podcast, grabbing a book? What's the best way for them to connect with you?
No, I appreciate it for the book. If they're interested in grabbing a copy of the book, they could go to getwealthyforsure.com. Getwealthyforsure.com. It's also the title of the book. There'll be a link there that you can access a copy of the book. And then also there'll be a link there with videos of case studies that we have done. And then there'll be another link just to book a call with myself and my team to explore options for yourself. So that's getwealthyforsure.com. And for everyone in this great community, my direct email is just mc@mclaubscher.com. mc@mclaubscher.com. Just shoot me an email and said, hey, I listened to your interview with Devin, and yeah, we'll connect.
Appreciate you, brother. Thank you so much for your time and sharing your wisdom with us.
Thank you.